Hi, everybody. So nice to meet you again. I think I was so-called away for a few weeks because we are taking turn to do our FB Live. I really hope you all had your dinner already. So, okay, today we are going to talk about is the market going to crash? There's a lot of talk that the market is going to crash. If you watch some of the YouTube, right? A lot of people are talking about it. So, do we want to be so concerned, or should we be even concerned if the market crashed? So what if it does, right? Before I share further, maybe I would like to bring you to this disclaimer. So whatever today that I'm going to share, it is more for educational purpose. So it is not for any form of investment advice. So if you need to do any investment, right, you must first start out with doing your own due diligence. Yeah. Okay, so for those who do not know me, hi, this is Lili, and I'm a Kashikoi trader. And in Japanese, Kashikoi is actually wise trader. So actually, I've been actually started investing in my early 20s. So, but over time, actually, I ventured into options trading as well. And most recently, I actually shared the same stage on Word of Wealth with this Matt Smith, as well as CEO of OIO, Rudy Lim. And previously was at this stage, the event called Wealth Toolbox Hacks. And the most recent is with Biden's band, Countdown Party. And these are some of the audience that were with us, the participants, right? Okay, so if you are value in that investors, do you need to worry? I mean, basically, as value investors, we are buying into business and not into the stock price. So whenever we trade in or invest in stock, right, we have to look at the fundamental of the business and make sure that it is really, really strong. For example, right, if the market crashed, do you still use Google? I think a lot of times when we need to check on something, we always say, hey, we go and Google, right? So whether the market is up, market is strong, we will Google for information. So for Google, right, the fundamental is strong. I mean, at least from what I do for myself, and we should not be too concerned about it. Right. So according to Warren Buffett, he says only buy into something that you're perfectly happy to hold if the market shuts down for 10 years. He mentioned here 10 years, not like 1 month, 2 months, or even 1 year. 10 years. Imagine, I think a lot of us will not be able to stomach it if the market shuts down for 10 years. Right. Okay, so before I even continue my next slide, I mean, I'm not too sure how many of you are watching now. If you're watching, maybe you can encourage me by giving me a heart shape, click on the heart or the like if you're a Singaporean or Malaysian or any other countries, or, just share this video so that other people can benefit from it, right? Okay, and according to Warren Buffett, this is the latest from Guru Focus that I extracted. He says that don't own stocks if you can't deal with a crash. Why? Okay, basically, to him, Warren Buffett is falling share prices are an opportunity, not a threat. And to value investors, even I for myself, I do buy stocks, right? We want the market to actually drop because when the price is too high, most of us won't want to chase the market. And when we price it, we find that it's too high, we will not go in. So usually value investors just can't wait for the market to come down so we can actually go in, right? So this is the reason why he says that don't own stock if you can't deal with a crash. And one of the reasons is that during such period, it is when the stocks are most attractive and there is a lot of opportunities presenting itself. And high quality stock can temporarily trade at prices that are significantly lower than their intrinsic value. That's why, when the market comes down, as a value investor, most of them would go in and scoop it up. And you can be sure that Warren Buffett will be the one right in front there to scoop up the value stock that he's waiting for. Okay. So if you are option trader. Okay, we just now we talk about investing, being value investors, right? If you're option trader, right, from like myself, especially, I'm more into option, right? Although I do go into stocks, we always say that we can profit when the market goes up, goes down, or even sideways. So it really depends on the strategy that we apply in the stock market and for which stock based on the trend as well. So if the market or the stock price drops, right, okay, we can actually take two strategy, that is buy put or sell call. So when you buy, these are more for bearish stock. Okay, we don't really want to recommend you to go into for strong stock, but more for very strong that is actually coming down, right? Because strong stock, it sometimes you may think it's coming down, but certain event it may just reverse and you can get stuck with it. So very stock, you can actually go in and profit and earn income from it. So by selling call for bearish stock, which is stock that is always on a downtrend, especially during a crash, it will go even further. You can sell it for income and you sell out of money. When you sell a option, right, in options trading, a contract, you actually collect premium upfront. So when you sell a call, you're actually collecting premium upfront, right? And this is a strategy for downward trending stock, especially if it's in a bearish market. And using this example, right, this is a stock chart that I've used for a while. I mean, it's not the latest, but this is a good example for this particular scenario. So for a downtrend stock, okay, basically you sell call at the top. This is the black line here at the top. That is when the resistance line, right? And at the top here, you sell and you let the contract expire because it's a weak stock. So tendency is that the stock will drop. Yeah. And then you sell here, it drop. Okay. You let it expire worthless, meaning to say that the contract has no value anymore. So you get to keep the premium in your pocket, right? And otherwise, let's say you don't want to wait for it to expire, you can actually close the position by buying back the contract when it hits your desired profit. Yeah, which sometimes I do that as well because I just want to wait. Right. So for options trader, we normally choose for sell contract position, right? That date to expiry of less than 30 days. So another strategy which I mentioned earlier is buy put. Okay, so when you do a buy put position, you actually can protect your portfolio or your stock. Let's say, for example, I have, let's say, 100, Facebook stock, right? And I'm afraid that when it crash, the stock may drop, or let's say that then may drop to, let's say, by 50%. So what I can do is I buy put when it is at the so-called the top because it's coming down, right? So I buy it at the top, means at the resistance. And when it drop down, I can actually, if it really drop really a lot, I can actually so-called exercise my option so that whoever who actually enter this contract with me at an agreed strike price will have to pick up the stock, even though if, touch wood, Facebook dropped down to zero, assuming the stock price was 1.5, or if I, of course it's not 150 now. Now Facebook is let's say 300 plus. Let's say if I lock in the price at $300, and if the stock were to drop to zero, when I exercise this buy contract position, right, the seller who entered this contract with me would have to pick up the shares even if it drops down to zero. So that's how I can protect my stock and my portfolio, right? So again, using this example, so this is more to lock in. When you do a buy put position, you lock in the current so-called high price for this stock because you expect it to drop, right? So when it drops, you can actually exercise it if it's really to advantage and make the other person who collect your premium and who take over your risk by letting him take over your shares if it's, let's say, drop down to zero. Okay, so you buy at the top and you sell at the bottom, assuming, let's say, I still want to keep the stock and it drops down to somewhere here at the bottom. I still want to keep the stock. So what I can do is I can close my position and I still collect premium for it. Okay, but of course, if the stock really drops down to really way below, I will just want to exercise my contract. Yeah. So this is when you buy at the top and you sell at the bottom. So for this particular strategy, we're looking at a slightly longer date to expiry of 90 to 120 days because of time decay. So we want to make sure that we have enough time. I know I'm using a lot of some of this technicality like time decay, at the money, out of the money, DTE, this and that. I can't really explain too much over at this Facebook Live because that one will require a little bit more time. But all I can say is for time decay, it is like a packet of milk. Let's say if you go to a supermarket, you look at two packets of milk. One is really like manufactured, like produced, like say today, okay, and with 1 month to expiry, okay. Another one is expiring, let's say 2 days later. Which do you think you will choose? The one that is going to expire 1 month later, or the one going to expire 2 days later? I don't think I want to choose the one that is expiring 2 days later because even though it is heavily discounted, yeah, because of time decay, they're heavily discounted. Chances are we are worried that if we drink, something may happen to us. So that's the reason of, that's how time decay plays against us for buy contract and options. Yeah. So let's lay Netflix, right? Okay. We look at this one. Let's say we want to protect. We are worried. Just now I use Facebook. So now we can use Netflix, for example, right? So let's say if you're expecting it to like come down. So let's say over here, right? Okay, at the top here, you're afraid that you're going to drop. Then you can do a buy put position for it to come down. Then you close here. Yeah. Then you buy here, you close here. So this is how you can actually protect your portfolio. And when it drops, you can actually sell the contract to earn your premium. But unluckily, let's say, as I mentioned, let's say it suddenly spike all the way down to here. From here all the way down to here. Wow, that would be a big drop. And let's say it continue to drop. You may want to exercise your contract to, let the person pick up your stock instead. And then you can actually, so-called, when you exercise the contract, you're actually selling or releasing your stock at this high price when you first lock in the price, even if the stock drops down to, let's say, zero. Yeah. So otherwise, if it doesn't drop that low, then you just sell at the bottom here to close your contract and you can collect the premium. Okay. Again, DTE is about 240 days. Yeah. So in such a market, do you buy put or you sell call? It really depends on what you want, right? So if you have some stock that you want to protect, you're worried that the stock going to crash to very low, right? You can actually do a buy put by locking in the current high price, okay? Or you can do it for individual stock and collect premium. And for when you buy put, your loss is limited to the premium that you paid. And your profit can be unlimited, okay? You enter at resistance and you can use it to protect your portfolio as mentioned, okay? Or you can use it to protect your stock as well. Or, okay, if you want to just collect income, then you would want to only do options on weak stock because it's always coming down. Okay, and during the bear market, it will be even worse, right? So, however, the loss is unlimited. Let's say for whatever reason, suddenly it turned around, then your loss can be unlimited. Okay, and the profit is limited. What does it mean by limited? It's because when you sell something, you collect, let's say you collect $10. That is the maximum profit you collect. That's it. You cannot collect more because you already collected that. You already sell that contract for $10. That's the limit, right? Okay, and then you enter resistance also. But when you do a sell call, for option traders, we do not sell naked call. We normally have covered calls. Again, I won't have the time to explain too much information at hand. All I can say is naked call means to say you do not have stock at hand and you sell the call contract, and you may run the risk in case the stock were to suddenly, instead of coming down, it reverse, and then you are forced to, let go at this price, but because you don't have stock at hand, you have to go to the market and buy at this price to give to the so-called the buyer of this contract, because you agreed to let go at this contract. Yeah. So you run the risk. So when you have covered call, it means to say you have some stock at hand. Okay, usually it's one contract is 100 shares, or you already have a long buy call position to cover this, so you can sell comfortably. Even if it's exercise, you just let go of your your call position, or you let go your stock to cover this position. Okay, so I'm hope you all have really enjoyed what I shared. This is basically about what I'm sharing today for a bear market. So what I can say is that I am going to share a bit more. I've been invited by the Create team to in this upcoming conference on the 11th and 12th of December. Okay, so I hope you all can join me on the conference by registering. You can actually scan to register, or maybe I will send the link later on the chat group as well. Okay, and you can also follow me on my Facebook. Yep. So I really hope you can you have enjoyed and really have gained something from it. Thank you.